So we're just talking about the risk-off mood, the sudden shift. Of course, we've got new developments in the coronavirus that is spreading, more deaths, more evidence as well from China that perhaps there is human-to-human contagion as well. Is this an opportunity for Asia-Pac investors to cash out ahead of the Lunar New Year holidays, or serious concern in the markets?
Well, there certainly is a setup here where people were prone to taking some profit and locking down positions ahead of the Lunar New Year holiday. And that comes in the context of what we think is the biggest situation in markets, which is this opposition between ex-medical concerns, as you just mentioned, a gradually but notably improving fundamental environment versus how much has been priced by last year's very good performance.
Right.
So the key setup here in dynamic is that conflict between fundamentals and valuation. And our sense here is that with the markets having had a very good run, particularly in the fourth quarter of last year, and then that extending into January, that with the holiday coming up and this new information that's come in, that's an opportunity to kind of square positions and lock things down ahead of the holiday.
Well, you had already said in some of your notes that you were expecting a bit of a pullback for Asian equities this year after this, this rally that we've seen globally has been kind of long in the tooth. So is this perhaps an earlier trigger than you expected?
I mean, it could be. I mean, there's always some sort of surprise. I mean, Donald Rumsfeld is famous for the known knowns, the known unknowns, the unknown unknowns.
Yeah.
And this latter concern about the coronavirus certainly falls into either one of those latter categories. It's certainly not the known knowns or the risk of, say, U.S. political election, which we could discuss perhaps later on. I have no differentiated view or knowledge in terms of whether this is going to become something more significant like SARS or something which could diminish.
It's too early to extrapolate onto
for sure.
comparison.
And
it's a similar virus. That's what we know. We're
Correct.
not talking contagion or anything like that.
And certainly there is a scenario where, especially in advance of the Lunar New Year holiday, when many people travel, and just given the greater connectivity we've got globally, the concern about some sort of contagion is not unfounded.
So maybe pull some money off the table, see how this transpires over the holiday, if it spreads, and then back into the market.
Perhaps. I mean, I think the larger point we'd like to make is that we think there's been a good reason, which we can get into later perhaps, for the market starting the new year on a good note, which so far has happened until this most recent dip that we've seen. That could extend further on into the first quarter. After that, our sense has been that the market would be vulnerable to some sort of a correction. Now, frankly speaking, that's not a terribly bold prediction to make, as every year's got its dips. But I think the point we'd make is that right now the tension between fundamentals and how much is priced is particularly acute. If I could just extend on that for one moment to put some numbers out, the MSCI Asia Pacific ex-Japan Index, which is the broader benchmark that we follow, is currently trading at 14.4 times 12-month forward consensus earnings. Now, the peak in the 10 years following the global financial crisis has been 14.1, 14.2.
Yeah.
When markets peaked in January of 2018, that was at about 14.2 times earnings. So we're right at the very, very top of the range, about 2 standard deviations above the 10-year mean, which suggests that the market is pricing a pretty robust recovery in earnings and is probably implicitly expecting even a bit more in terms of positive surprises. So that just renders it a little bit vulnerable to any marginal news that comes out that's a bit more concerning, and this coronavirus stuff could be just a catalyst that kind of catalyzes that situation.
We don't have the time to go through every market, but you tend to like North Asia. You like you like South Korea and some recovering fundamentals there. The chip cycle is going up, which
absolutely.
But back to this market, Hong Kong, kind of a double whammy of those bad news because you have the Moody's downgrade as well. I mean, that's going to really hurt some local companies which have most of their business locally here in the city. How is that going to translate to the stock market? Because the markets remained fairly resilient through the 7 months of turmoil.
Steve, that's absolutely true. So again, to get some numbers out to frame the conversation. So we had about a 15+% price correction from last July to sort of the lows, and the market's kind of bounced up from that. Fundamentally, of course, the economy has weakened significantly. We've had some negative GDP prints for both the third and the fourth quarter. We think that sort of extends into the first quarter. I would say the downgrade that we've seen, those typically tend to be lagging indicators from a stock market perspective because they kind of embody what's already well known and well priced. So the key dynamic in Hong Kong is almost the exact opposite of what I just mentioned, where the fundamentals are weak, but the market's looking through those. Whereas the other one for the region more broad is the fundamentals are improving, but the market's already has rallied. So, our sense here, and we're sort of market weight on Hong Kong because we think that's the appropriate way to balance the fact that, yes, indeed, the domestic fundamentals are soft, but they've already been priced in. For example, you take the property companies, they're trading at discounts to their net asset value, which are well below what the typical NAV discount is.
Asia Pacific, sectors to dip into and sectors to avoid.
So very clearly, as you mentioned, we like the North Asia, we like tech hardware. That's where the most dramatic recovery in earnings is likely to come. So just again, to frame this numerically, last year we saw close to 40% decline in the profits of the semiconductor or the tech hardware sector more broadly. This year we think there's easily off that low base a 30% recovery. So that's the most likely dramatic increase in earnings that has been anticipated by market performance, but we think there's more to come through. So we like sort of the selective cyclicals, and we're more cautious on banks and defenses.